Vikas Kumar Jain joins us. He represents CLSA. Let's connect with him. They've come out with a very interesting report on how to understand tapering. We'll talk about it. But before that, Vikas, suddenly there is a swing in terms of mood, participation, and appetite for a market where bulls are feeling immortal, let's say 2 weeks ago. Now the bears are saying that we exist in the game.
Well, I mean, that's volatility is the name of the game when it comes to markets. But I think even when we are trying to play this, see, there is two approaches to this. One could argue that the bull run is over. If that is the case, then maybe that's a different argument. We are not in that camp. So if we're not in that camp, then we should clearly not forget the premise of this bull run. The premise of this bull run is based on real economic growth coming back. So that is why if the bull run continues, then the growth linked sectors should continue to do well after possibly this temporary blip. So I think that's how one needs to approach the market.
Yeah, houses come out with a very interesting note on tapering, something which we are discussing extensively. What is your sense? You think markets are already factoring in the effect and the after effect of tapering?
Well, I won't say that markets are factoring, after effects of tapering or so. See, what is happening over the last few days as the Fed minutes kind of made the markets a bit nervous on tapering being a little before what earlier expectations were, is markets are trying to use 2013 taper tantrum as a playbook, and people are perhaps positioning accordingly. That's something which is pretty visible from if I were to further go down and to look at things which are doing well and things which are not doing so well. In fact, in our report, which has been published today, what we highlight is the performance of the market and growth assets in general last week was similar to what happened after the first sign of tapering was done in May of 21, when the then Fed chairman had kind of presented himself in front of the Congress. At that point, however, there are things which are very different this time, which makes us believe that the impact may not be as intensive as we saw last time. Firstly, both Fed and market participants have that as a playbook. So, and even RBI to some extent, because in case of India, the big thing which happened as a reflexivity was the big depreciation that INR saw. So in about a month from that point, INR depreciated by almost about 7.5–8%. RBI should be pretty cognizant of that. Plus, our situation in terms of forex reserves, etc., is much stronger than where we were at that point of time, and current account deficit is also much lower. So for us, that learning itself, both for central bankers as well as for market participants, means that the impact, in our opinion, will not be as deep as what we saw in 2013. But most importantly, from an equity market standpoint or from an asset market standpoint, going into the event, markets were extremely jubilant at that point of time. So till about May, 1 month into that third week of May 13, markets were doing very well. Growth assets were doing very well. Commodities were up. Like copper was up. Most equity markets were up significantly. Nifty was up, for example, by 5% or so. So there was a lot of positive sentiment and significant positioning. I think that from that perspective is already getting corrected even as we get into the Jackson Hole event. And I believe if we do not get clarity in Jackson Hole, then the next one will be the Fed meet on 21st or 22nd September. So possibly market participants are already using that as a playbook for this time. And that's why a lot of that impact which happened after the announcement is already playing out. So I would tend to think that this news will be, once it is out, will be digested by the market reasonably well. And I think from there on, the bull rally should resume the way it was continuing. So growth sectors or growth assets, from a perspective of equity markets in India, it's commodities and banks, they should start doing well again, and defensives should take a backseat.
Okay. Why are banks underperforming? If the scenario which you've constructed about earnings recovery, growth recovery, then banks have to be the biggest proxy. Are markets indicating something that all is not well because banks have to rally, which they are not?
So that's precisely what I was trying to suggest, that the scenario that I'm painting is the scenario that will play out once this news is digested. So the whole taper nervousness could continue till we get the final clarity, either later this week or in third week of September when the Fed meet happens. I think once that happens, market could continue to be a bit nervous till then, and thereafter. See, one thing that we need to bear in mind that both the U.S. economy as well as in the Indian economy is a way more stronger footing they are at way more stronger footing now than at that point of time in 2013. Most of the key economic benchmarks that Fed would track are way above long-term average levels, whether it is unemployment, whether it is GDP growth, and even inflation that they've been trying to get above that 2%, which is comfortably higher now. That was not the case last time. So once this news is digested, markets will realize that, growth is much stronger. So the growth scare will subside, and that is when that growth trade should be back, which is banks start doing well once that news is digested.
Sure. Vikash, so far we've had a great run when it comes to India equities, be it from the lows of 2020 or for that matter year to date itself as well. But the underperformance in the broader end of the market, A, does it really perturb you? And B, is it okay for us to give up some of our recent outperformance, be it concentrated amongst mid and small caps?
See, India has been a massive outperformer. So over the last 12 months, India has outperformed EM benchmarks by almost about 12 percentage points. So even over the last 1 week or so, it outperformed by 4 percentage points. So India has been a huge beneficiary of this over the last few weeks. I think going ahead, given where relative valuations for India are, some of this outperformance may be given away. However, the construct of the market could also change. India's outperformance has, if you think about it, has largely been led by defensive sectors. So what has been doing well is FMCG and IT. That's exactly the kind of sectors which were doing well after the taper tantrum in May. And I think what will happen is this time it will be a bit of a reversal, nervousness going into the news. And once that news plays out, although the other markets which are more commodity heavy could do better than India for some time, but within India itself, there's going to be a rotation back to growth sectors. That's what I think will happen. So it's really a bit of a growth scare, is how I would see this. Which is, maybe if you think about it, this is the first kind of a tightening measure by the U.S. Fed. That's why a bit of a growth scare.
Interesting. So how is it that you suggest one can tactically realign their portfolios amidst this growth scare that you highlighted?
So I repeat that, the narrative of the bull market is the upcoming economic growth as the pandemic or the effect of the pandemic subsides. And I think that's what we need to be positioned for. And if you were to further look into, so from that perspective, this nervous period, which may last maybe a few more days or a couple of more weeks, is the point where we look at some of these opportunities which have become even more attractive to take a bite and position ourselves for the next leg of the growth trade, which should start, post the Fed meet, definitely. So sometime towards end of September or October is when the trade kind of picks up again. So I think that's what one needs to position for. The other thing that I'd also want to highlight is financials in India. India would be amongst the few markets in the world where financials have underperformed YTD. And that's something which I believe is odd. And I think that's something which is set to reverse. So I think from that perspective, this period should be used to realign one's portfolio to again become a little bit more growth heavy, as markets are nervous around the growth part of the trade.
Okay, that makes sense. Hi Vikash, this is Mubina as well joining in. How real a fear do you see the Delta variant being at this juncture? We've seen a majority of the cases in America being the new variant. Closer home as well, we're seeing, of course, the emergence of cases in certain pockets. Do you see that as an event that could perhaps push talks of taper or clarity of taper even beyond September, or do you think it's too early to say that?
There are two parts to it. First is the Delta variant and the impact of that in the US. See, so far, the data that has been coming out, the rate of hospitalization as compared to cases is much lesser than in earlier waves. And the other part of the argument is also what happens if there is a third wave in India. See, I think that's something which none of us are baking into our scenarios if there is a deep kind of a third wave in India. And, the effect of vaccination isn't as, the efficacy isn't that great. And that's something which is what I would call not built into any of our scenarios. At this point of time, what we are thinking about it at this point of time, possibly, there is not going to be a significant third wave. That is what is baked into our estimates. Therefore, the growth which was picking up as state lockdowns have been relaxed should continue and possibly further pick up going into the festive season. And, that's what happens. And that also coincides with the time when post the Fed meet. So going into the festive season, the confidence on that growth picking up in India should also play out. In terms of the US, so far, economic data hasn't really shown any significant impact of the Delta variant. So I think Fed will be dependent on the economic data. If the economic data starts showing up, clearly, I think the learnings from 2013 would be that even the communication as well as when they are trying to pull out of this easing measure, they are. My thought process is that they're going to be pretty gradual and careful about it.
Okay. Now, prior to this event, the event has of course not yet happened, but we've seen quite a bit of a run up in growth assets. You mentioned we saw that, in 2013 as well. And, you make a case that, once this passes by, use this opportunity to build a portfolio of growth assets once again, like commodities and financials. Do you think that they will go up with the same gusto? And I'm of course talking about commodities here, because metal stocks have more than doubled in this last 1 year, trebled in some cases. Do you think it can go up with the same gusto even as the US has slowly started pulling the plug, like you mentioned, which I'm sure they will do in a gradual manner?
So my conjecture is, we are possibly somewhere, in the midst of a massive bull market.
No, okay. I think we seem to have snapped that line with Vikash. We'll just try and reconnect with him. But yeah, he is definitely pretty optimistic from his tone. He believes that yes, once this little bit of scare is over, we should be once again back on our growth trajectory. He's making a case that, stick with your commodities, go with financials. These are great, ways to play a market which he believes is purely on the growth path. Once we get clarity, of course, from the Fed, until then, there may be a bit of skittishness that can come by for the market. And, that's what we are seeing right now as well. It's just been the first 15 minutes, of course, of trade. And we do have gains of just about 0.33% for the Nifty 50. Okay, we've managed to connect back with Vikash. Vikash, continue your point.
So what I was saying was growth assets have definitely done well. But from here on, if you were to look at, this has been a pretty significant bull market, and I really doubt it will end in a whimper. So from that perspective, maybe there is at least one final leg of the bull market left, which should have some of these growth assets doing very well. Mind you, the banking index hasn't really crossed its Feb highs yet. So I would say that there is at least one more leg, if not more, of the reflation trade, which is left for us.
Okay. What will happen to pharma? It's a sector which, in a sense, everyone thought was the leadership sector, same time last year, for COVID, for other factors. But this is one space which has got smoked. How much of the price challenge in pharma, and I'm not talking about stock price here, generic pricing, inventory issues, those are temporary?
So I think, pharma, what we had done was in March, when the second wave was just kind of picking up, we found an opportunity in defensives as well. And at that point of time, we added a few pharma names. And on a relative basis, valuations of pharma were much more attractive at that point of time. And defensives in general, there was an opportunity. From that point onwards, there was very quickly, in a matter of a couple of months, a 20% kind of a rally. I would say that unlike IT, which also presents itself as a way to play, IT at times can be in a sweet spot where it is seen as a defensive, but it also is a way to play global kind of a growth. Pharma doesn't have that characteristic, and with generally with some of the impact of COVID subsiding, people wanted to play more, move beyond some of these defenses that pharma had done pretty well. So I would say that yes, the sector is taking a breather, and in general, it is not very high in our priority because, like I explained, that during this nervousness, I'd much rather kind of take a bite into the other growth sectors like financials and commodities.
Okay. If interest rates they start moving higher, now because now that happens this year or next year, we don't know. But let's say if interest rates they go higher, what will happen to tech and the valuations because the discounting changes?
That is true for the market in general. So, of the various parameters which are showing some kind of frenzy or the other, there is one, if you were to kind of look at some way compare bond valuations and equity valuations, equity doesn't appear to be that expensive from that perspective. And as interest rates start going higher, that differential, say for example, simply one way to look at it is if you were to compare earnings yield for Nifty and bond yields, the 10-year bond yields. The differential isn't something which is where big tops have been made. Yes, it is higher, very higher than historical average. So I think from that perspective, this would add to another point where either equity has a significant rally or bonds kind of go up. The differential from a relative attractiveness perspective for bonds can rise, and that could be another reason which could be a worry for equity as an asset class. So from that perspective, yes, further tightening measures. See, at this point of time, what Fed has been saying is that it is more about tapering the asset purchases, and they will keep interest rates low for a longer time. If that changes for whatever reason, maybe for the reason that this inflation that we are seeing is perhaps not as transient as what Fed believes it to be, then that could be a challenge for equity markets.
Vikas, great to have you on the show. Thanks as always for taking the time out and speaking with us today.
Thank you.